Okay, touch base with the management of Bank of Baroda. PS Jayakumar, who's MD and CEO of the bank, joins in to talk more about their numbers. Mr. Jayakumar, it's great to have you on the show. Thanks very much for taking out the time. Good morning to you. Congratulations, firstly, for a better quarter. Apart from high slippages, largely due to IL&FS, the overall exposure there, the operating level performance has been strong. What have been the key drivers helping the same?
I think what has led to the performance is that we've been continuously working on building the franchise, the transformation journey, whether it is improvement in product, processes, distribution, training, technology, digitization, etc. The end result of which is manifests itself in the financial outcome. So it's interesting that for the fifth quarter in a row, we are growing. Our growth in domestic credit is between 15 to 20%, in excess of 15%. And this quarter was also, this quarter also on a year-on-year basis has been quite impressive at an average growth of 23%. Now, on all parameters, we've been discussing all that directionally, that in all parameters we should see improvement, whether it is growth numbers or it is absolute amount of net NPA or NPA as a percentage, provision coverage ratio, fee income. So when you look at and also the quality of the portfolio as is represented by the data we give in rating distribution, credit score distribution, etc. So when you look at all of these factors, it's a fairly consistent story of improvement all around. As far as the provisions is concerned, we've stepped up provision more than what we need as per IRAC norm to be a bit conservative on certain exposures, certain large exposures. But on an incremental basis, which is to say that the net slippage and the net recovery kind of match themselves out. And although we had the IL&FS, the increase in the NPA on account of IL&FS, the provisions were really taken last quarter. So there is no provision impact on account of IL&FS. So all of it is gone only principally to improve the coverage ratio. So now the coverage ratio is quite healthy at 73%. I think in all, I think it's an improvement across all parameters, but the underlying story behind it is improvement in the total franchise in the way it's getting built up, and that really is reflected or manifests itself in the results.
Okay, net interest margins have improved. Can expect further improvement in domestic and international NIMs?
I would think it will continue to move upward for two reasons. One is that the international portfolio, the margin improvement is been quite robust. If you went back 3 years before, it used to be about less than 1%. Today it's close to 2%. We can see a continuing trend there, and the domestic margin should also improve from here onwards, because the incremental assets that we are putting on are giving full revenue, and the impact of the non-performing asset gets diluted each time with the improved provision. So I would think the margin should improve. I mean, we should try to come to 3.25% from here on overall, and that's what we're working to.
Right. Mr. Jayakumar, your slippages were high, and I guess that was largely because of the IL&FS exposure. So firstly, just on IL&FS, what will be the provisioning needed going forward? And given that at an SPLB level, we are making only standard provisions.
So let me first correct the overall slippage this quarter ex IL&FS is around 1674 crores, and it's the lowest we have seen in the last 5 quarters. In fact, quarter after quarter we see the new next slippage numbers, the slippage numbers on a gross basis are lower than the prior period. As far as IL&FS is concerned, we have an overall exposure, I think, of about 4,600 crores, out of which the 1125 crores on respect of which we have moved into NPA relates to the parent. The balance are all with the SPVs. Now, as far as the SPVs via finance is concerned, they've all reached a completion perspective, in the sense that the projects are all completed. We are also fully secured creditors, so in a sense, in the priority waterfall payment, we are placed ahead of the others. So overall, when we look at the SPV level story, I do think the downside risks are somewhat limited overall. And again, just to break that up further, the SPV level, about 2,800 crores are absolutely fully performing, whether it's paying us or paying every other creditor. And the remaining one, we are fully secured, and the cash flows that are coming into the escrow account are adequate to service our loans. So when we take all of this into picture, I see the downside from here as fairly limited. even from an SPV perspective. That really is the position.
Right. So if you look at slippages ex-IL&FS, it has been a multi-quarter low. Can low slippages sustain given that stress still continues in certain segments?
Well, I would put it to you this way, that as we look at the data points from here on, give or take 5% kind of variation, we think our net slippage and our recovery should would kind of tally. I mean, should kind of balance. If not, the recovery should be more than the slippage. So from this point of time, we think the gross NPA numbers should be reasonably steady at this point of time, and the net NPA numbers would continue to improve on account of recoveries as well as on account of the provisions. So overall, I think we are reasonably comfortable with respect to the slippage. In fact, all the big accounts are already reflected. Whatever has to slip has slipped. We do have some more accounts, but they are not of a magnitude that should disturb things significantly. Should disturb things. So I'm hoping, we are not hoping. Our plan is that the total amount of slippages and the total amount of recovery should kind of net off each other at a minimum, and therefore we should see the net NPA numbers continuing to improve in the sense that they will be lower than the prior quarters.
Right. Analysts have highlighted two key concerns. One, need for capital due to merger, and second, concerns on kitchen sinking due to the merger. How would you address these risks?
So I think when we look at our capital adequacy ratio for Bank of Baroda in itself on a totality, which is the consolidated numbers, it's at about 12.65% overall, and CET has been close to about 9.85%, and that numbers have been stable, which means the incremental loans that have been coming have been of a better quality, and what has run off is of a lower quality. So net the effect on capital from an RWA perspective has been has not been there. This quarter we have had some transfer of some capital to the subsidiary on account of regulatory reasons in United Kingdom, and so that is a 30 basis points reduction, but that would get offset as we come to the end of the year when the profit for this quarter gets added to the balance sheet. So I think we are pretty okay so far as capital is concerned. Now, as far as amalgamation is concerned, we are doing that exercise thoughtfully. We don't have all the information as yet. And I would tell you that what we are thinking in terms of what I think will most likely happen is around 1st of April, we would make a full analyst presentation. At that point of time, we'll look at the strategy of the combined amalgamated institution and then see how the value of the firm will be better than the sum of its part. So I think we have to wait for a little while, but it's unlikely we're going to do anything. I mean, I can assure you that nothing irrational will happen, but if provisions have to be taken, they have to be taken, whether it is in our book or India banks or the other book. But at this point of time, I see the downside risk of that being fairly low, because times have elapsed and the risks, all the NPA numbers are out, and and quarter after quarter the disclosure levels, everything else is improved. So I think the downside of that scenario happening is less. There would be differences in the accounting policy which have got to get harmonized, and so what I'm saying is, let's just wait for a month or maybe till 1st of April, and we'll have all the data.
Jayakumar, we leave it at that. Thanks very much for taking out the time to speak with us. Appreciate your insights and details. Take a break then, but as we do so, here's a quick programming note for our viewers. As per the new TRAI tariff order, you now have the power to choose and pay only for the channels you love. To keep watching